Welcome to the course Introduction to Commercial Banking and Fintech. In this particular course, in the last two sessions, we discussed about some of the nuances and very detailed understanding about the internal rating based approach. And the internal rating based approach, in the last session particularly, we focused on how to calculate the probability default and what is the meaning of probability default, how banks categorize the probability default. If I have to go about finding the values of probability default, if I have to go for classifying the borrower, that whether the borrower will have the higher rate of default and whether it is sensitive, whether it requires monitoring. So, all those details we discussed, and I hope that understanding helped you to explore further with the statistics and modeling. We also saw that with the emergence of large data based models and especially the big data setup, the probability of default calculation has become really a cumbersome task, and with the application of complex models it is further becoming. But some of you may be taking up the banking jobs later, and those who are already working with those banking setup, you may be finding that this understanding must have shaped your thought process in building up the models for the commercial banking, and understanding that the commercial banking is a complex process. It is not just the accepting the deposit and lending and all those models that we discussed for the bank run and others. It is also linked with how banks are managing their own default scenarios. So, further to internal rating based approach in Basel II, which was introduced in 2004, we are now getting into calculation of two more measures, which is called loss given default and exposure at default. So, loss given default is the fraction exposure lost if default occurs. What is that? So, LGD is nothing but 1 minus recovery rate. And what is the recovery rate? So, what are the drivers of loss given default? So, collateral value and haircut, that how much they have, seniority and legal enforceability, that how much they have, and these are self explanatory. The recovery process and even the business cycle, the macro conditions. So, in recessions, collateral prices fall and recoveries weaken, and this is where the challenge comes in when we have the loss given default, and in this period the loss given default rises, and then we have to apply different types of norms to this, and this is where the concept of the loss given default comes in. So, I have given some of the examples here. For example, if the loan amount is rupees 100 crore, collateral after haircut is suppose 70 crore, what is the recovery rate? Recovery rate is just 70%, right, and loss given default is how much? So, 1 minus 0.7c. So, 30% is the only loss that the bank incurred, and loss if default occurs at EAD. So, loss, so how much we have? So, here we have loss given default into exposure at default. So, exposure at default is, so exposure is 100 crore. So, here it is 0.3 multiplied by 30% is 0.3 multiplied by 100. So, it comes out to be 30 crore, which means that loss is 30 crore. So, that is quite applicable here, that loss is 30 crore, but if you want to calculate, so you can do that by multiplying loss given default with the exposure at default, and good collateral it reduces LGD, and lowering loss further improves it. LGD example 2 is the unsecured loan. So, here loan amount is 200 crore and recovery in liquidation is 40 crore. So, this is what here we have. So, recovery rate is how much? It is 40 upon 200. So, it is 20%. So, this is what here we get, and loss given default is 80% we are saying. So, how much is the loss if default occurs? So, loss if default occurs, it is going to be 160 crore, because the recovery rate is, so here we have the recovery rate is just 20%, 80% there is already loss. So, if I have to calculate the loss, then it will be 160 crore. So, this is what we implied. So, which means that it also talks about the vulnerability of the shock or default that we are going to see. Now, if I have to get into the exposure at default, what do we have? So, exposure at default is the outstanding at the moment of default. What is the outstanding amount? So, EAD is basically the outstanding principal that the loan has, and revolving credit line is nothing but current outstanding plus likely drawdown before default, right? How much was the maximum and coming down. So this is what it matters, and it also matters for the reason that it helps you understand how much the bank experienced the default on the total exposure. So this we calculated EAD into LGD, right? So this is what we get. Suppose the example is, suppose original loan is 500 crore, outstanding at default is 420 crore. This is what here we have. So EAD is how much? Exposure at default is going to be 420 crore, and if LGD is 50%, loss given default is 50%. So loss of default is how much? 0.50 into EAD. So this is what, so it is 210 crore. And why it matters? Because if the exposure at default is higher, then you have the LGD playing a key role. So because you are multiplying directly, right? So if the LGD is suppose 0.25, then it is just half, right? And if it is 0.75, then again you will have to add the half of it. So you can say 3/4 of 420 is on default, which means that loss given default is also one important parameter that we have to always keep in mind, and this creates a lot of confusion among the credit limit is suppose 1000 crore, current usage is 600 crore, expected drawdown before default is suppose just 200 crore we are going to get. So exposure at default is going to be how much? It is 800 crore, and if the loss given default is 40%, so 40% of 800, which is going to be 300 crore. So which means that if you are having the, you can think about the credit limit. For example, a bank is allowing me to borrow suppose 100 crore rupees, but I am utilizing only 60% of it, right? So my exposure will be now only on 60%, not on the 1000 that we are concluding. So this is what it implies here, right? So this is how the important parameters looks like. Now here we have, suppose if I have to combine all these three into one, so how do we do that? Suppose probability default is 5%, loss given default is 60%, and exposure at default is rupees 100 crore. So if I have to go for expected loss, it is going to be 24 out of 800 crore, which means that loss given default and probability default matters a lot. Even with moderate probability default, high LGD or high EAD can generate large expected losses, and this is where it plays a very important role. And in order to deal with, there will be role of agency theory. Your bank will be paying more attention that they should not be going for what is adverse selection, and moral hazard will be playing a role here. Right, so this is what banks measure credit risk via all three margins. So screening, collateral recovery, and the limit utilization, all those things will be the important part of the. So screening is for PD that we use, then collateral and recovery is loss given default, how much they have, and limit utilization is exposure at default at this amount. So this is what we often find. Now let's get into some of the important problems that we get. Suppose a bank lends to a mid-sized manufacturing firm backed by collateral. The term loan outstanding at default is rupees 120 crore. Suppose the collateral market value is 110. Haircut on collateral is 30%, right? So fire sale, which means they immediately want to sell, legal cost and all those things will involve 30%. So collateral will have the less weightage now. Now probability of default over 1 year we calculated through logistic regression that we saw, it is coming out to be 4%. So now the question is compute recovery rate and LGD, compute expected loss, which is PD into LGD into EAD, and then we can infer upon this. So recoverable after haircut is going to be how much? It is 77. So this is the collateral value. Recovery rate is going to be how much? Recovery rate is going to be 0.64. So this is what it implies. Loss given default is how much? Loss given default is going to be 1 minus 0.64. So it is coming out to be 35.8%. So what is the expected loss then? So 0.04 that we got into 0.3583 that we have got. So this we have converted in percentage into 120 crore that here we have the exposure. So it is coming out to be 1.72 crore approximately, which means that collateral reduces the loss given default, because here you can see it is coming out to be 0.64, 1 minus 0.64, so it is coming out to be just 0.358, and this is what the expected loss. It also moderates the expected loss, and this is very, very important to understand. Now suppose if I have to understand the credit line, that how is the credit line working in this direction, right. So here what we learn from this is that if I am going to get into, so here if I have to get into finding out, then we can say that a bank lends, here what we are saying is that we calculated the recovery rate. So what is the learning? So if you remember, I had used about something called limited commitment and default premium. We discussed this, right. So limited commitment and default premium, what does it mean? It means that on the collateral we are having the loss. So why limited commitment? Because banks ask for collateral because they want to avoid they don't know about you, they don't have details, so they rely on whatever details you reveal, but those details may not be sufficient, so they go for asking for collateral, so that in case if there is default, so loss given default will be much lower, and this is where it becomes important to highlight that why this concept is important. Now another topic that we are often dealing with is the case for the haircut. So haircut, suppose it is 30%, so here you can see the recoverable collateral is just the 77, and then we can see that once we have the collateral value going down, it comes up. But if the recoverable collateral value goes up, then again the loss given default will be much lower, and it will be more favorable for customer, right. Now we are going to see the drawdown risk, that what happens to drawdown. So a working capital credit line where stressed borrowers draw down limits before default. Suppose we have a credit limit 500 crore, utilization is just 260, expected additional drawdown before default is going to be 140. So this is what here we have. Expected recovery net of cost is just 120, and probability default over 1 year is 6%. So if I have to calculate the exposure at default, recovery rate, loss given default, and the exposure at loan, so this is what it implies. So exposure at default here is that it is about 260 plus 140, so here it is coming out to be 400. Second is the recovery rate, which is coming out to be 120 upon 400, so 0.30. So loss given default is how much? It is coming out to be 0.70, so this is what we imply. So expected loss is going to be how much? Expected loss is going to be 0.06 into 0.70 into 400, so it is going to be 16.8 crore, so this is what we get. So exposure at default is 400, this is what we imply. Recovery rate is 0.30, this is what here we have. Loss given default is 0.70, and expected loss that here we have is the 16.8 crore. So this is what we imply. So the idea behind this is that this is about the expected loss that here we have. So credit line ledges the expected loss through higher EAD under stress. So this is what we get into. Now let me highlight one more aspect. I think it is worth mentioning here, that drawdown that we are getting here, it is coming out to be 400. So this is what exposure at default is going to be. We have 260 to utilization, 140 we are expecting the drawdown that we will have. So 400 is exposure at default. Recovery rate that we are having just 120. So out of 140 it is just 0.3. So loss given default is going to be how much? 0.70. So expected loss is nothing but probability default is 0.066%, and then here 70% is the LGD, and my exposure is 400 crore. So my expected loss is going to be 16.8 crore, and this is what it makes the case very interesting. A long gestation infrastructure loan where recovery is worsened in downturns. Suppose we have the exposure at default coming out to be 800, probability of default over 1 year is coming out to be 3%, and then here we have the normal time recovery rate is, suppose if it is 55% and downturn recovery rate is 35%, then can we calculate loss given default and also the expected loss during normal period? Then can we also calculate the loss given default and expected loss during downturn, and can we also comment on whether it is aligned with the Basel norms, the loss given default or not? Here two things you have to note down. Here we are focusing on, so if you know the business cycle, let me just give you the idea. So here we are assuming that this is the peak and this is the trough, this is slow down and this is recovery, right? Now we are seeing that this is a slowdown, so this period what we are considering as the downturn, right? So this is the one. Normal time we are considering this period, so when the economy is recovering and it is going to the or this period, right? So this is what we are considering. So loss given default during normal time, it is how much? So it is, you can see that it is coming out to be normal time recovery rate is 55%. So only 55% we get the normal recovery. So this we have 55, so it is coming out to be 0.45. So expected loss is going to be how much? Since probability default is 3%, that you can see. So this, if I have to calculate the normal time and this, so then you can always go through the business cycle literature. On the NBER website also, you have the business cycle dating data. Or based on the qualitative understanding, not just the qualitative, quantitative, based on the qualitative understanding, given the past and the future's likely scenario, you can create three scenarios, which is called best scenario, then base scenario, which is normal scenario, and worst scenario, right? Suppose I assume that economy will achieve the growth rate of 7%, and I will have the host of factors to explain that these are the factors, right? Then here we have the best. Best is 10%. I have these many list of factors to highlight, and similarly I say that worst will be 4%. Right, so this is what we get. So worst is 4% implies this, right? So this is what here we have. So compute, if I am going to have the normal time recovery, so during this period, if I can get the data of the total loan exposure from RBI, or you can say what is the percentage of total NPH. So GNPA data is available on the RBI website. So you can see during a particular period how much has been the GNPA compared to the previous period, and based on that you can easily calculate this normal time recovery rate that we are calculating 55% and downturn recovery rate. So 1 minus that will be the recovery rate that we can see. So LGD normal is nothing but it is 1 minus 0.55, so it is 0.45, and expected loss is how much? It is the PD into LGD into exposure. It is coming out to be 10.8 crore. So this is what we get. So PD plays important role, and also the LGD. So these are the cases, and downturn is going to be 0.65. So this is what implies. So expected loss is nothing but here we have the 15.6 crore. So this is what we are mentioning here. Now in terms of summary, if I have to just think about what will be the learning from this particular module that we are learning. So here it will be, the first case will be the probability default, that how we measure the likelihood of default over a period. Then loss given default, how loss given default is playing an important role, and also the exposure at default, which is also playing an important role in handling. And in most of the scenarios what we find that it is the expected loss that matters. So let me summarize what we have done so far in today's session. So first is that we went for the CAR, which is the capital adequacy ratio, right, and in CAR we calculated the capital upon RWA, and RWA it was very raw, right. So weights were given and then you don't have any control on that, you just solve it. So banks were using securitization as a rule. Now the second aspect that we saw in the Basel norms, that the Basel norm focus on the RWA through the standardized approach, and internal rating based approach. So internal rating based approach, what it implies that here we migrated from macro to micro. And in micro, as I mentioned, that it started with the first is the rating that we did, rating was linked with this. Then here we have the second one, which is related with the utilization of the customer data, right. So this is what we have. And classification of borrowers. And then we also saw that once we have calculated the probability default, so since it is a negative variable, the lower is considered higher, and we saw that certain threshold can also be imposed like 3% or so. So it matters the most. The other aspect that I am thinking about is that we can also apply different types of mathematical modelings and other tools to improve. Then we have the LGD, loss given default, and EAD, which is the exposure at default. What is the purpose here is that if I have calculated probability default, what is my loss that I am going to see if the borrower is not going to, or borrower is going to default. Now for the bank, if they are just going to have the probability default, that will not be just sufficient. So they actually calculate how much they have. The improvement on this could be in terms of the next level of exercise, could be in terms of a stress testing that I am thinking of giving you the background about, and second would be in terms of different systemic risk measures, right. So if I have to think about building up on these aspects, so I think it will be good that we can also discuss about different types of. So maybe instead of going by probability default, if I go for calculating value at risk, where then it matters the most, that how value at risk will play a role. And accordingly, if I am going to value at risk can be augmented further. If I am going to see that how much is the risk spillover happening because of failure of bank, then the co-aware kind of setup. So instead of saying that details data 3% is the default, if I am calculating value at risk, and that shows that how much with the given level of confidence, how much in a day or in a month or in a year a bank will lose or bank will make a loss. So these angles are important. I think going ahead in the further lectures we will be touching upon these angles and trying to gather as much details. And in this particular course my objective is also not to deviate a bit away from the commercial banking which is being taught in India to a more modern and contemporary kind of course, wherein we can touch upon some of the banking research based topics also. So maybe I think after this we will be touching upon that, but my plan is to first cover the Basel III norm, and then after that we will be touching upon this aspect, and maybe we will have some more examples to look at. So with this I hope you are enjoying the course, and any feedback is most welcome. And I would request that please spend time in understanding the calculation of probability default, exposure at default, and loss given default, because these are very important things. Nowadays you have different certifications being offered by the banking organizations and even the finance organizations, and there also these topics are discussed. So it will be a good source to look at. I don't know about FRM, how much FRM, financial risk managers cover this topic. In CFA I am sure they must be touching upon these topics, but those who are working with global banking systems like HSBC, Barclays and all those big organizations, it will be a day-to-day affair to have the deep discussion and understanding about it. With this I am stopping it here, and thank you so much. I really appreciate it. Thanks a lot.